Tesla has reported its steepest drop in quarterly revenue in over a decade.
This is massive. So what's happening here is that Tesla shares have basically collapsed, and so have its sales, partly because of Elon Musk's connection with Donald Trump.
Tesla just hit a wall, wiping out over $17 billion of Elon Musk's net worth. After years of soaring profits and headline-grabbing hype, the company is now facing its biggest financial blowout in a decade. Sales are slipping, revenue is falling, and Elon Musk, he's busy fighting political wars while investors panic. From missed targets to disappearing tax credits, it's all starting to catch up. The numbers are brutal and the timing couldn't be worse. Something big is unraveling, and Tesla might just go under for this. So how much money did Tesla actually lose this quarter? And is Elon Musk's political chaos making things worse? Welcome to AutoCast. In this video, we will break down exactly what went wrong at Tesla, what the numbers reveal, and why some analysts think this might be the start of a major collapse. Let's dive in.
Tesla is blaming supply chain problems for a decline in profit.
Tesla's results for the second quarter show a sharp drop, don't they? Both in revenue and in profits too.
Tesla just posted its worst quarterly financials in a decade, and the numbers are tough to spin. The company brought in $22.5 billion in revenue for Q2 2025. That's a 12% drop compared to the same time last year, when revenue hit $25.5 billion. This is a company that for years was riding high on soaring sales and rapid expansion. Now that growth has come to a screeching halt, and Wall Street is watching closely. Dig deeper, and the picture looks even more troubling. Net income for the quarter dropped to $1.17 billion, down 16% from last year. That's a sharp dip for a company that once touted double-digit growth every single quarter. And while Tesla's top-line revenue is still sizable, it's the breakdown that's alarming investors. Automotive revenue, the part of the business that brings in the bulk of Tesla's money, dropped 16.6% year over year, falling from $19.9 billion in Q2 2024 to just $16.6 billion this time around. Then there's operating income, which took the hardest hit. Tesla's operating income fell by a staggering 42%, slipping below the $1 billion mark for the quarter. This is what the company earns after paying its day-to-day costs, and it means Tesla's core operations are becoming less and less profitable. Much of that decline has been masked by one thing: the sale of regulatory credits. In the second quarter, Tesla earned $439 million by selling credits to other automakers. Without that boost, their profits would look a lot worse. What's important to understand is that these regulatory credits aren't sustainable. They've been a reliable lifeline for Tesla over the years, especially in rough quarters, but the rug is about to be pulled, and we will get to that in a few. The second quarter also saw declining margins across every major product line. The average selling price per vehicle fell as Tesla offered steeper discounts to drive sales. Pair that with higher production costs and softer demand, and the company is feeling the squeeze from both sides. And while Tesla still beat Wall Street's modest expectations, it did so with numbers that signal a deeper problem. Growth is slowing, margins are shrinking, and there's no immediate fix in sight. So what happens when the very thing that's been propping up the books is on its way out? Well, that's where things start to spiral. So let's break down the looming disaster Tesla faces once those credit sales disappear for good, and why it might be the company's most serious financial threat yet.
Boycott Tesla! Boycott Tesla!
Elon Musk didn't just dip his toes into politics, he dove in head first, and Tesla's paying the price. Over the past year, while the company faced growing competition, falling profits, and major strategic setbacks, Musk was tied up in Washington. First, he led the Department of Government Efficiency, or DOGE, a Trump administration effort that quickly turned controversial. The department promised to reduce government waste, but instead drew global criticism for gutting humanitarian aid programs and firing thousands of federal workers. Musk eventually stepped away from that role in May, but the fallout hasn't stopped. Instead of stepping back into Tesla full-time, Musk decided to escalate things further. He announced plans to start a new political party, the America Party, in direct opposition to Republicans who supported Trump's latest budget bill. This move triggered a messy public feud between Musk and Trump, splashing across headlines and making investors increasingly nervous. For a company that depends heavily on public trust and brand image, this kind of political chaos is exactly what Tesla didn't need. Tesla's brand image has taken a serious beating since the beginning of the year. What was once seen as a forward-thinking, clean tech brand has started to carry a lot more political baggage. Protests have erupted at Tesla dealerships across the US, Canada, and parts of Europe. Activists have accused the company of aligning itself with policies that contradict the clean energy and climate goals Tesla used to champion. In Germany and France, multiple dealerships were vandalized earlier this year, windows smashed, vehicles tagged with anti-Musk slogans, and security costs rising as a result. Even longtime fans have started to distance themselves. A recent consumer sentiment survey showed a sharp drop in Tesla's brand approval ratings. In the US, favorability among EV buyers under 35 fell by nearly 20% compared to last year. The shift isn't just about politics, it's about trust. For many, Musk has become a polarizing figure, and when your company carries your name and image at the front of every major decision, that kind of personal backlash spills into the business. Investors have noticed too. Tesla stock surged over 50% after Trump's election win in late 2024, largely due to hopes that Musk's influence in Washington would benefit the company. But by mid-2025, nearly all those gains had vanished. Analysts say the political drama has created too much noise and not enough focus. Shareholders expected Tesla's CEO to be solving production issues and launching affordable models, not trading barbs on Capitol Hill. It's no longer a question of whether Musk's political side quests have hurt Tesla. The evidence is clear. He's taken his eye off the ball, and while he's been busy building a new party, Tesla has been losing its grip on the market. But politics isn't Tesla's only problem. As Musk wages battles in Washington, the company is struggling to hold its ground against global EV giants and policy changes that are about to make selling cars even harder. Let's dig into the perfect storm brewing for Tesla. For years, Tesla had a secret weapon that kept its financial engine running smoothly: regulatory credits. These aren't cars, batteries, or software updates. They're essentially a financial bonus from governments to companies that make clean vehicles. And Tesla, as a major EV producer, cashed in heavily. Whenever traditional car makers failed to meet emission standards, they had to buy these credits from companies like Tesla to avoid steep penalties. It was a win-win for Tesla. They didn't have to do anything extra, and the money came rolling in. Since 2019, Tesla has earned over $10.6 billion just from these credits. That's not pocket change. In fact, there have been quarters where these sales made up the difference between profit and loss. Earlier this year, Tesla's credit revenue even exceeded its net income, which means that without those sales, the company would have posted a loss. This wasn't a one-time thing either. It's been happening repeatedly, especially as profit margins have thinned in the last couple of years. But here's the problem: that safety net is disappearing fast. The new tax and spending bill pushed by President Trump and approved by Congress eliminates the fines that made regulatory credits valuable in the first place. Automakers no longer face penalties for exceeding emissions limits, which means they have no incentive to buy credits from Tesla. Analysts expect Tesla's credit revenue to drop by 75% next year and disappear entirely by 2027. This change hits Tesla where it hurts. The company's core business, selling cars, is already under pressure from declining demand, rising competition, and shrinking margins. Now, it's losing a massive income stream that has propped up its financials for years. William Blair and Company analysts put it bluntly: without regulatory credits, Tesla becomes unprofitable. And that's not a distant future concern. Gordon Johnson, a longtime Tesla critic, says the fallout could begin as soon as Q3 this year or early 2026 at the latest. The credits helped Tesla survive during the rough patches and funded expansion when cash was tight. Now that funding source is drying up just as the company faces mounting pressure from all sides. There's no easy replacement and no quick fix. And if that wasn't enough to worry investors, the next blow comes from Tesla's very own leadership. While the business struggles to stay afloat, Elon Musk has been busy, just not with Tesla. Let's take a closer look at how his political side ventures may have helped drive the company off course.
Elon Musk did not just sell vehicles, he sold a vision. And for over a decade, Tesla led the charge. It led the EV revolution. But today, that future feels a little...
Is the business is in decline. I don't think we need any more evidence that their traditional EV and energy business is in decline.
Tesla used to dominate the electric vehicle market without breaking a sweat, but that era is slipping away fast. The competition today isn't just growing, it's exploding. In China, BYD has already pulled ahead of Tesla in total EV sales. That's not a fluke. BYD's strategy of offering a wide range of affordable electric vehicles at breakneck speed is working. In 2024, they beat Tesla in global deliveries. Now, in 2025, they're doubling down in Europe and are expanding aggressively with models that undercut Tesla's prices by thousands of dollars. It's not just BYD. Japanese and Korean automakers like Nissan and Hyundai are also catching up fast. Hyundai's Ioniq series and Nissan's Ariya are proving popular across Europe and North America, especially as they offer comparable range and features for less money. These companies aren't playing catch-up anymore. They're setting the pace, and unlike Tesla, they've been quicker to release affordable EV options and build partnerships to increase charging infrastructure. Meanwhile, Tesla is stuck in a holding pattern. Their promised low-cost model is still in early stages, and volume production won't start until late 2025. That delay has opened the door wide for rivals to steal market share. Many consumers who might have bought a Tesla 2 years ago are now looking elsewhere and finding solid alternatives. On top of that, the clock is ticking on one of Tesla's biggest selling points, the federal EV tax credit. Since 2022, buyers of certain Tesla models have qualified for up to $7,500 in tax rebates, making the vehicles much more attractive. But starting in October 2025, those credits are being phased out under Trump's new spending bill. Once those disappear, Tesla's vehicles become significantly more expensive overnight, especially as the company is no longer the cheapest option in the market. There's also the issue of tariffs. Trump's revived trade war policies have jacked up import duties on foreign-made parts and materials, many of which Tesla relies on. While Chinese EVs are facing massive tariffs in the US, Tesla is getting hit from the other side. Components like lithium, semiconductors, and battery materials have all become more expensive to source. That directly raises Tesla's production costs, shrinking already tight profit margins. Then there's the broader economic pressure. Inflation, higher interest rates, and cautious consumer spending are making it harder to sell big-ticket items like new cars. Tesla isn't immune to these trends, and its current strategy, offering limited-time discounts and financing deals, is only a temporary solution. As incentives dry up and costs continue to rise, the gap between Tesla and its competitors is closing fast. So Tesla's future seems bleak at best, and the company's immediate problems are rapidly piling up. Investors want to believe in the big picture, but with each passing quarter, patience is wearing thin. So what do you make of Tesla's latest crisis? Is this just a rough patch, or are we watching a giant lose its grip? Drop your thoughts below, and if you enjoyed this breakdown, give us a thumbs up and subscribe to AutoCast for more deep dives just like this. Until next time, stay curious.